It looks like it's going to be more difficult to buy a house in Donald Trump's America because mortgage rates have soared. So here's a mystery. Why have US housebuilder shares been so perky? The jump in mortgage rates mirrors the jump in Treasury yields since the election. Borrowers are looking at a 3.9% interest rate on a 30-year loan today, compared to 3.5% before the polls closed. The last time that rates moved this dramatically, this quickly, was during the 2013 taper tantrum, and they caused a drop in home sales and a sharp deceleration in house prices. Yet the index of the country's largest house builder shares is up about 5% since last Tuesday, and that's almost twice the rise in the broader S&P Super Composite. It's erased a lot of the sector's recent underperformance. Now, partly the sector's been swept up in the wider enthusiasm about the Republican ascendancy. The new president's promised tax cuts and infrastructure spending could boost the economy. And if they boost wages too, then they might make up for the dampening effect on the housing market of those rising borrowing costs. Another thing, the new Congress might also ease restrictions on financial firms, potentially stimulating mortgage lending. Now, as for recent data on the US housing market, rather like the Trump victory, investors can read what they want into that. There was news on Thursday of stronger than expected housing starts, suggesting that builders are looking confidently to the future. But existing home sales have been volatile all year. House builders' earnings have been disappointing, and the outlook is not obviously brightening. Many companies are focusing on the construction of smaller and cheaper, less profitable homes, aware that the student debt burden on millennials is going to be a drag on what they can afford for years to come. And industry executives continue to complain about a shortage of skilled labor, which drives up construction costs. Whether or not President Trump builds his wall, discouraging immigration is only going to make that problem worse. Investors know that the equity market's positive judgment on the new administration is provisional and contingent on how events unfold. But when it comes to house builders, it may simply be wrong. Stephen Foley, Financial Times.